Hi, how are you? I'm Dan Whitaker, and this is Alex Sneed. He's a tax manager here at Whitaker. We just want to take some time and give you some tax updates and some stories that we're seeing and changes in tax laws that we're seeing with our clients. Our topic for today's tax topics, is the pass-through entity tax. Alex, do you want to give some history on that?
Yeah, of course. So the pass-through entity tax, most taxpayers remember before the Tax Cuts and Jobs Act, you were able to deduct your state and local taxes. So what that meant was there was no cap really on how much you can deduct on your federal taxes personally, what you paid personally for your state taxes. What you paid personally for your state taxes, you could deduct federally. And so the Tax Cuts and Jobs Act came, and part of the law is that they changed it and they capped it to $10,000, and it's been that way for the last couple of years. And the states have been working diligently to try to find a workaround for that. So as of 2021, California and about 18 or 19 other states finally came up with a workaround where they allow for owners of pass-through entities to elect to pay a tax based on a percentage of their taxable income and pay that at the entity level, and so that they can yield a federal tax deduction.
Got it. So when we talk about who that applies to, really that applies to any shareholders or owners in partnerships, S corporations, or LLCs that are profitable. So if you're an owner of a partnership, S corporation, or LLC, and it's profitable, this is something that you want to be considering. We've had this applied to almost all of our clients. So it's something that's very beneficial. And people have been asking is, hey, how much is this going to save us? If we do this, how much is this going to save us? And there's not a direct answer, but I will give you kind of a quick example, and it's kind of right here. If you're an owner of an S corp or a partnership or LLC, as we talked about, and the profit of the business is about $250,000, based on California tax rates at 9.3%. If your federal tax rate was 35%, you would save about $8,000. So we've done this enough now that we can look at it and say, really, our net savings is about 3.5% of your federal taxable income. And we've got several clients that, they've had sale of businesses, they've had sale of properties, they've had businesses have just been doing great during the pandemic. So in many cases, it's been savings much greater than that. But it's something that you definitely want to look at because this is important, and it's a legal tax loophole, right? California and about 18 or 19 other states created these loopholes because the federal government would not allow us to deduct our state taxes. That's what was known as the SALT cap, state and local tax cap. Alex, do you want to explain any caveats around this?
And I want to use a caveat too. Using the word loophole kind of implies that it's not legal or that it's a shady area of the law, but the IRS has actually blessed this structure. The IRS has approved it for all of the states. And so
that's a good point.
When Dan mentioned the legal loophole, the IRS has actually said, yes, this is acceptable, this is okay. They've issued guidance on it. So it really is a legal loophole, not to the tune of what we're used to hearing of legal loopholes, people using it to circumvent or avoid taxes. Some caveats though with the law is written specifically for California. I can't really speak too much to the other states' laws. I mostly practice in California state law, and the caveats are right now as the law is written, if you sell your business and you had a large taxable income for California, to make your estimated tax payments to qualify into the following year, you have to pay 50% of what you paid in the previous year. And so you can imagine if you had a sale of a business, 50% of a sale of a business, you have to basically front load a lot of cash to qualify for your 2022 pass-through entity tax. That's as the law is written, that's as the FAQ says on the California website. Whether this changes or not, we don't know. There's been a lot of shifting, a lot of law changes, last minute amendments, last minute bills that passed Congress. We just recently had a law passing in the California Congress I think about end of February,
Mm-hmm.
that shifted who qualified and all of this stuff. It created a delay in the forms getting released, and it kind of created a crunch in our filing deadline. So who's to say the law as written is going to be how it's going to be in the next deadline? The crucial date, June 15th, is when you would need to make your estimated tax payment. And why this is important is because if you don't make this estimated tax payment by June 15th, then you don't get to qualify, you don't get to participate in this pass-through entity tax deduction for the 2022 tax year. So those are a couple caveats, and I think things to watch out for and really pay attention to. Talk to your CPA, talk to your tax advisor, and really talk to them about June 15th, how that qualifies for 2022. The 2021 tax year, that already has closed, that's already in the books. So 2022 is what we're gonna look at next.